Hi guys, welcome back to the channel. Please make sure that you like, subscribe if you're not subscribed already, and then also just make sure to engage with us in the comments and share the videos with your friends. Yes, so whatever that we're covering today is going to be linked in the description below. So we're going to link the past paper, we're going to link the solutions, and then also going to link the video that the playlist that this video is on, so that you can check out other videos as well, as some of the videos basically build up to the next one. Anyways, without wasting any more time, let's get straight into the question. That we're looking at in this is question 3 of the June 2024 paper, linked in the description as already said. So we're looking at the interpretation of financial information. So let's read the question quickly. The information relates to Brightsun Limited. The company sells high quality solar panels to businesses and homeowners to generate electricity. The financial year ends on the 28th or 29th of February each year. And then it says where comments are required, you must quote a financial indicator to quote financial indicators and trends with figures and then give reasons or explanation for the relevant financial indicators. I think that's quite clear. So let's go into the first question. So the first question is on the markup percentage, and it says explain how customers reacted to the change in the markup percentage and whether this benefited whether this benefited the company or not. Okay, so how did the customers react? So we're going to start with how customers reacted, right? And then after that, we say whether it was a benefit to the company or not. So let's look at how the customers reacted first. So let's see. Here's our financial indicators and additional information. The markup in the previous year was 40% to 60%. So that's an increase. So as a result of it increasing, how did it affect the other matrix within the business? Well, the number of customers reduced from 280 to 245. So the first point we can make is that the number of customers decreased from 280 to 245 as some of the customers would not afford a higher price. And then we look at the average sales per customer. This is now positive. So we can say that even though there was a decrease in the number of customers, the spending per customer has increased from 120,000 to 160,000. And then the last part then is to basically state whether it was a benefit or not. Well, it depends on how much money the business made. So if we're going to take the 280, we'll multiply by the 120,000 to get the figure, then compare it with 245 multiplied by 160,000, so that we get the amount of sales that would have been generated in each of the financial years, and then we can decide then if it was beneficial. So let's get straight into it. So I'm going to write down the answers here. So let me just erase some of this. So we're going to say that the number of customers reduced from 280 to 245, negative reaction, as some customers may not afford a higher price. Cool. But secondly, we can then add something that on the other part, there's a positive reaction because the average spending per client increased by 40,000, and then you can just show how you worked out that 40,000, that it's 160,000 minus 120,000. Positive reaction, And then the last part is to say whether it was beneficial to the business. Now, if it was beneficial, we'd have to see the amount of sales generated, right? So we're going to start with the previous year. That in the previous year we had in the previous year there was 280,000. So you wouldn't have to write this on your paper, but it's just a calculation that you make on your side. So 280 customers spending 120,000 each customer. That was about 33.6 million. Let me just convert that. Yes, that's 33,600,000. And then let's look at the after the markup increase. So we had now 245 customers, and each customer now is spending 160,000. So if they're spending 160,000, the business now is generating what? 39.2 million. Okay, so the comment would then be it is beneficial for the business as revenue increased from 33.6 million to 39.2 million. Okay, cool. So this doesn't need to be here, but it was just for the sake of calculation. And you can also show this maybe in the brackets if you want to show your working. But for this amount of work, 4 marks is warranted because you should be getting 2 marks for each point, and you made 3 points here. And I wanted to make the last point because there's a key thing that has been said there that you need to explain the benefit. So we need to look at the reaction and then state whether it was a positive or a negative. All right, cool. Then now we move into profitability and operating efficiency. And the question here says that you need to comment on the operating efficiency of the company over the past 2 years and quote 2 financial indicators. So let's see then. Let's see. So let's look at the financial indicators then. So these are the financial indicators. Let's look at something because operational efficiency has to do with operating. So, when we talk about operating, we're talking about the income statement because that's where we generate our operating profit. And so we have some other measures to then check our operational efficiency. So the first part I would look at is the operating expenses on sales. So the percentage that it was last year was 26%, and now it is 22%. That is an improvement. And then the second thing that I would quote is the operating profit on sales, which is 10.2% to 15.6%. That is also positive. Now, you may wonder why I say this is positive when it went down, but then when this one went up, I say that it is also positive. Now, obviously, expenses on sales, expenses as a percentage of sales, you want your expenses as a percentage of sales to be as low as possible, right? Because it means that if it is low as possible, you don't spend much of the money that you generate from sales paying off expenses. Whereas operating profit on sales means how much operating profit does the business keep from the sales that it generates. So the higher that amount is, the more money the business is able to keep after making sales. All right, so let's make the comment. I think just those two ones will make our comment very clear. So I also use comment on the operating efficiency of the company over the past 2 years, quote 2 financial indicators. So we're going to make a comment and then we're going to quote our financial indicators. So we're going to say operational efficiency of the company has improved, right? And then we quote our ratios. So we're going to say operating expenses on sales improved from, so we'd say that it improved from 28% or improved improved by 6 percentage points, which is basically 6 percentage points because it was 28% and now it is 22%. So it is improved by 6 percentage points. And then we quote another ratio that operating profit on sales improved. How much did it improve by? Because I think you had 15.6% and 10.2%, so that's about 5.4%. So improved by 5.4%, and then the calculation would have been 15.6% minus 10.2%. All right, so then that would make our comment. Cool. So yeah, let's move then into the next question. And this was for what? For 4 marks? Yeah, for 4 marks, that is enough. All right, in the next question, I'll actually use this and then I will use this one to look at the ratios. So now looking at the answer book again, it says one of the shareholders cannot understand why the debt equity ratio increased in 2024 despite an increase in loan. Provide an explanation for him. So this is a fairly straightforward explanation because the debt equity ratio is made of debt and equity. So as loans increase, yeah, you do expect it to, decrease. But if you also increase the share capital or retained earnings, then that would cancel out that decrease. So let's have a look then in the ratios themselves to see if maybe there was an increase in some of the equity. Let's see. So do we have equity? Number of shares issued, maybe. Okay, we don't know, but there is this information here, yes. Shareholding of Alan Bushwan, so 400,000, number of shares owned, price per share, dividends per share, it's not saying much. Oh yes, there is this. So you can see here that yes, the business may have taken a loan of 1 million. You can see that there was an increase in loan, but the business also issued shares. So to explain here, so it says provide an explanation of why the debt equity ratio increased in 2024 despite the increase in loan. We'll just say that there was also an increase in ordinary share capital as new shares were issued. Fairly straightforward. Then let's look at 3.3.2. So 3.3.2, it says that the Chief Financial Officer is of the opinion that the increase in loan was a good decision. Apart from the debt equity ratio, provide 2 points to support his opinion, including one relevant financial indicator. All right, cool. So I will start at the financial indicator to make my first point, and then we'll move from there. So let's see. So the first point that you want to make when we look at whether it's a good idea to be increasing loans is you want to look at your return on capital employed. So return on total capital employed, let's go back to the ratios. There it is, ROTCA. So you can see that our return on capital employed improved from 11% to 19.7%. Okay, so let's point that out then. So we're going to say that ROTCA improved from 11% to it improved to 19.7%. All right, so that would be the first point. And then the second point, because it says that we need to, so it says that we need to quote aside from the debt equity ratio. So the other thing that I would then look at is the interest rate on the loans. So the interest rate on the loans, which I will then also compare with the return on capital employed. Let's see if we can find the interest rate on the loans. So the interest rate on the loans is 13%, and it is 13% in the current year. And you can see then that the business, so we're going to say that now the business generates, because you can see that in the previous year, the business was generating 11% from capital employed, but it was paying 13% in terms of interest. But now in this case, there's a positive amount generated because there's an interest rate of 13% and a return on capital employed of 19.7%. So we're going to say that the business is benefiting from the loan because um, it is generating a positive degree of gearing. That's what you call it. So a positive degree of gearing, and then you're basically going to say, to quote it, you're going to say that we're generating 19.7% ROTCE versus 13% interest paid on loans. All right. So yeah, that's what you would need to say. Now let's move on to question 3.4. So 3.4, let's get to that. So it says comment on whether the shareholders should be satisfied with one of with their return on the investment. Provide 2 points, including one relevant financial indicator. Okay, so if you are happy as a shareholder or not, you basically need to be looking at, well, how did it improve from the previous year? And then the other thing you need to look at, well, the interest rate that you would get on other investments. So let's make our first point. So we're going to make our first point based on we're going to make the first point based on the previous year, and then we make our second point based on the interest on other investments. So here's the return on shareholders' equity. So we can say here that shareholders should be happy because, so I'm going to say here that shareholders should be satisfied. We're going to say ROSHA improved from 8% to 15.6%. Then we're gonna point out again the similar thing in the previous question, that the fact that now we have 15.6% that we generate, and we compare this with the interest rate on the investments. Okay, the interest in alternative investments is only 7%, which means shareholders have more than doubled their return compared to alternative investments. Okay, I think this made this points too long, but it is fine. Okay, cool. So now let's go to 3.4.2 and look at the next question. So 3.4.2, what does it say? It says we need to comment on the earnings per share and explain its impact on the dividend payout policy adopted by the directors. So comment on the earnings per share and explain its impact on the dividend payout policy adopted by the directors. So let's look at the earnings per share then. And then we'll look at the dividend payout policy. So earnings per share, well, there's a big improvement. So we're going to say earnings per share improved massively from 113 cents to 234 cents. Let's look at the dividend payout rate. Well, in the previous year, the business paid out 80% of its earnings per share, but now in the current year, it is only paying out 40%, which means that the business probably has some expansion plans as it is keeping most of the profits and reinvesting them back into the business. So let's make this point. So we're going to say that we're going to say earnings per share improved from it improved from I think it was 113 cents to 224 cents, which shows an increase in profits. All right, and then the next comment that I'm going to make is on the dividend payout policy. So the dividend payout, so the dividend payout policy reduced from 80% to 40%. Now, keyword I used there was reduced. I didn't use reduce is not necessarily an opposite of improvement. I don't want to say improved or not because it can depend on what type of a shareholder that someone is. But what does this indicate is what I want to focus on. So this indicates future expansion plans for this business. Cool, because if you are keeping a lot of the money that is generated, it means that there's an intention from the business to expand its operations in the future. For the next question, we're looking at 3.5. It says comment on the performance of the share price on the JSE. The stock exchange provides 2 points with figures to support your answer. So the points that you can make here about a share price is basically looking at the market price of the shares and then also perhaps looking concurrently with the net asset value of the shares, because with the NAV, that is what we would consider the intrinsic value of the share, which is basically its actual value based on equity versus what it is trading as in versus it's how it is trading in the stock market. So let's start with the market price of the shares to see how the shares are currently trading. So the shares, as listed in the JSE, you can see that the market price improved from 1,342 cents to 1,610 cents. So we're going to say that the market price of the shares improved from it improved from 1,342 cents to 1,610 cents, indicating an improvement in profitability and future expansion plans. Because we did see in the other things that the EPS improved and then also the dividend payout policy decreased, which means that the business is planning to reinvest more of its profits towards expansion. Now, you don't have to code that because we've just coded the market price of shares here. And then this market price of shares, we want to then compare it with the net asset value per share. So let's see then if says comment on the okay. So let's look at the net asset value per share, and then we compare it with the this. So the net asset value per share, you can see that the shares are trading higher than the net asset value. The shares are currently trading higher than the net asset value. The net asset value, which is 1523, and it's 1523. Let's check. Is it 1523? 1543 cents, indicating a positive market perception about the company. Because obviously, if people are willing to buy the shares, so if the investors are willing to buy the shares at this company at a higher price than the NAV, it means that the perception of the public is that this company is a going concern, and it's going to generate even more returns into the future. All right, and now let's move to 3.6. So for 3.6, what is the question? So it says Alan Ashwin owns shares in Bright Sun Limited. He is pleased with his investment in the shares of this company. Provide 2 points with figures or calculations to support this answer. Okay, cool. Let's see some of the things that would be beneficial for him. So the question is set up as we have the calculation at the top, and then more of like a comment at the bottom. So it's not like wait, it's point 1, point 2. Sorry, because we're still in 3.6.1. Okay. So let's look at the information relating to that. So there is Alan Ashwin. Alan Ashwin shares an issue on 29 February is 700 cents. He owns shares in issue, yes, and then he owns 360,000 of these shares. He bought these shares for not for what? So he bought these shares. He bought the shares for 780 cents, and then dividend per share that he earned was 90 cents. So what would you do here? So some of the things maybe that you would be happy by. I wouldn't focus too much on the return on investment, even though that's also like a point that one can make. But I would just point out how much he received in dividends, or the return that he got as a result of having dividends in the company, sorry, as a result of having shares, because he basically earned dividends of 90 cents multiplied so 90 cents multiplied by the number of shares. So that's how much he earned. So, and you can do this maybe as a percentage of all the dividends, or you can simply do it more so as just an amount. So I would quote an amount actually. So let's quote an amount here. So we can say that he earned dividends at okay, cool. So I think let's just read the question. So it says, okay. Oh, he's pleased. So we want to support the opinion. So he earned in the current year, he earned dividends at 90 cents per share, which equals So this equals, obviously, how many shares does he own? He owns 360,000 shares. So that's going to be zero point 0.9, which is 90 cents, multiplied by 360,000. 360,000 times 0.9, that is 324,000, which equals 324,000. So let me say 324,000, and then we can just show our working here that it is 90 cents times 360,000. Okay, cool. So that's the first point, that he would be pleased because obviously in the current year that's how much he earned. And then the other thing that we would point out is basically the amount he paid for those shares, because he paid for these shares 780 cents, and now these shares are currently trading at almost double the value. In fact, double the value, because if it was 800 cents, that is. So it's basically trading at double the value. So we would point out then that he purchased the shares for 780 cents per share, and now they are currently trading at 1,610 cents. They're currently trading at 1,610 cents, so more than doubled. All right. So key thing here, in order to be so basically the important thing here is this: to how so basically you want to look at, well, how do you get your money back as a shareholder in the company? So the way you get back your money is through dividends, and also through the appreciation of the price of the share, because some companies don't pay dividends, for example, and since they don't pay dividends, the money that the investor is going to make is basically when the share price goes up, and then they're able to sell those shares at a much higher price than what they purchased them for. All right. So yeah, that's how I would look at it. Now, the next question we're going to be looking at is 3.6.2. And what does it say? It says the company plans to issue additional shares equal to 20% of the current issued share capital in the next financial year to existing shareholders. Alan has indicated that he will not take up this offer. Explain how this will affect his shareholding, provide calculations to support your explanation. So basically, we need to firstly figure out, well, currently how much does he own of the company as a percentage, and then two, after there's been a share issue, then how much shareholding will they have, and then we can make our comment then that how is it going to affect him. I think this is a situation where he goes from being a majority shareholder maybe to then being not a majority shareholder and lose some influence in the company. Well, he loses control of the company, but he can retain some heavy influence because he will still be at a higher percentage. All right, so let's look at it then. So for the calculation, we're going to look at the current shareholding. So the current shareholding percentage, so the current shareholding percentage for this particular investor is is what I say 50. So basically, he has 360,000 shares over how many shares? Well, it is over 700,000 shares. So 700,000 shares. So that's currently the amount of shareholding that he has, which is basically 51.4% of the company. Now, after share issue, after share issue now, he will still own the what is it? So he will still own 360,000 shares. But now, how many shares will be issued? Because it says here that there will be 20%. So basically, additional new shares equal to 20% of the issued share capital already. So that means then that the shares that had been issued, which is 700,000, will issue 20% more than that. So we're going to then take 700,000, just multiply by 120%, or you can just multiply by 1.2. So now your new denominator is that, and so the shareholding after that, we will then have a shareholding of 42.86%. And then how is this going to affect him? So let's state our points. Okay. I want to check now also the amount of marks that are here. So I think there's about 2 marks, so 4 marks in the calculation because you calculate the previous shareholding, the current shareholding, and then you make an explanation for another 2 marks. So we're going to say that he will lose majority ownership of the company. This will also then reduce his influence on the decision making of the company. He will still be influential because with 42%, you still have some influence, but it's not a case that if you say something, then you basically have all the vote to pass some of the things. All right. And then lastly, we got 3.7. So let's look at what 3.7 says, and then we finish this question. It says here, apart from the points provided above, state 2 different factors that will influence shareholders to vote of approving such bonuses. So this needs me to go back and read because this means that there may be some bonuses that were there. So it says that bonuses for directors and other employees. Bonuses for directors and other employees included in the company's budget. Shareholders will be required to vote in the AGM on whether the business should be paid, whether the bonuses should be paid or not. So it says, apart from the points provided above, state 2 different factors that will influence shareholders to vote on approving such bonuses. Some of the things that will influence the shareholders. So the first thing is basically the working capital as well as the liquidity of the business. So because you want a business, so you don't want a case where you pay a lot of bonuses and then you lose liquidity to be able to take care of the other daily expenses because you spend money on bonuses. So there's that consideration. So we're going to say that liquidity will matter when deciding bonuses. The current liquidity of this business is, let's see, so we're going to say is bad or good based on the ratios that you're going to look at. Well, we have the current ratio 1.8 to 1, and then the asset test ratio is 0.9 to 1. Okay, so we'll maybe state that is fairly okay. So we're gonna have the current ratio, which is 1.8 to 1, and asset test ratio, which is 0.9 to 1. So liquidity wise, the business is in a fairly good financial state. It's not amazing, but it's decent enough to be able to pay bonuses. Next, the other point to look at is basically how is the business doing operationally, because you have to justify it. If employees are doing well operationally, then you might be able to grant maybe some bonuses. And they say that we don't want to consider the points we've already made above. So I won't go into, well, they increased their earnings, profits improved and all of those things. That doesn't matter as much. So the other thing that I would point out that we haven't maybe spoken about is this. So we have cash generated from operations that has massively improved. So we can say then that we would consider cash generated from operations. Cash generated from operations, and we can also point out then that there has been an improvement. So the improvement in cash generated from operations is from what? So it is from 3.8 million to 6.7 million. From 3.8 million to 6.7 million. Okay, so those are some of the things that maybe I would consider. And maybe let's see the other information that's there. Um, Maybe the fact that there's lesser employees, so there's lesser employees, you can be able to pay these even better because it won't be as high if it was to maybe a lesser number of employees. And yeah, and I think that then would make our point. So we've made our 2 points, which are liquidity. So we have to consider the liquidity of the business. I think the other thing we could have included maybe is the solvency as well. And then also just the cash generated from operations. And yeah, that is pretty much it. And until next time, cheers, guys.